All right, I want to talk about diversifying your portfolio and if there's a right way to do it or a wrong way to do it. I've got 3 examples of some legendary investors and how they diversify their portfolio. Number 1 on the list is Wu-Tang Clan.
You need to diversify your bonds.
Just kidding. No, seriously though. The first investor I want to talk about is Kevin O'Leary. He's known for being the host of the TV show Shark Tank. Kevin O'Leary has a very diverse portfolio, and he's been known to say that he doesn't like to have more than 5% of his portfolio in one investment. And if it doesn't pay a dividend,
he ain't gonna touch it.
I mean, I can't even imagine buying a stock that doesn't pay a dividend. Why would you do that? What would be the reason you would do that? I don't get it. So to me, that means about 28% of the market, to me, is just speculation. A stock that doesn't pay a dividend is a speculation. It's not an investment.
His number 1 position in his portfolio is Home Depot, and that's only 4.86% of his portfolio. Personally, I think his portfolio is spread a little too thin, and for that reason, I'm out. I've always wanted to say that. Number 2 on the list is Bill Ackman. He's the founder and operator of Pershing Square Capital Management. Now, Bill Ackman only owns 6 companies in his portfolio. His number 1 position is Lowe's at 23%, then Restaurant Brands at 17%, Chipotle Mexican Grill at 17%, Hilton Worldwide Holdings at 14%, Howard Hughes at 13%, and Canadian Pacific Railway at 12%. Bill Ackman loves to put his money into high cash flow companies.
But what's the checklist you kind of go through?
So we look for very high quality businesses, what we describe as simple, predictable, free cash flow generative, dominant businesses, a business that Warren Buffett would describe as having a moat around it, right? If you believe that the value of anything financial is the present value of the cash you can take out of it over its life, well, you need to know how much cash it's going to generate over its life. So business quality to us is the single most important criterion for determining what's interesting. Because if we can't predict the cash flows, we don't know what it's worth. If we don't know what it's worth, we can't invest. So we figure out what it's worth, figure out how good the business is, how predictable will this cash flows be from a railroad or a spirits company or a real estate company, shopping mall business. And then we say, okay, well, where's it trading?
Number 3 on the list, and we couldn't leave this guy out, the GOAT, Warren Buffett. Warren Buffett loves to put his money into companies with great moats. And when I say moats, I mean companies with great competitive advantages in their industry.
You know, what we're trying to do is we're trying to find a business with a wide and long-lasting moat around it, protecting a terrific economic castle with an honest lord in charge of the castle.
And although Warren Buffett is invested in about 40 different companies, the majority of his money is in his top 5 holdings, including over 38% in Apple.
Apple is Berkshire's top holding, accounting for about 40% of the company's portfolio. That's about 4 times the size of the next closest company, Bank of America, which accounts for just more than 11% of Berkshire's holdings. Up next is Chevron. The oil giant accounts for just shy of 10% of Berkshire's holdings, while Coca-Cola, one of Buffett's most famous investments, particularly given his insistence on always sipping that soft drink, represents 8.5% of the portfolio. And American Express, a longtime holding of Buffett, rounds out the top 5, accounting for 7.5% of Berkshire's holdings in this.
Not all of Warren Buffett's investments pay dividends, but his top holdings do, and he gets paid billions of dollars a year in dividends.
My stomach just growled.
So if you were to ask me if there's a right or wrong way to be diversified, I would say no, as long as you are diversified and you're invested in great companies and for the long term.